Three reasons why LYFT stumbled on the second day of trading. But investors are treating the stock very differently than they were on its IPO day. Shares plunged 12% to $69.01 on Monday, giving up all of their gains from last week's debut and then some, closing $2.99 below the IPO price of $72. This isn't how IPOs are supposed to work. Typically, more than 41.6 million shares changed hands on Monday after 71.5 million shares were traded on Friday. The company only there. In the absence of momentum, LYFT has some challenges in building a long-term investor base. First, there is no obvious public market company that can serve as a comparison. Uber, which is second, LYFT is part of a crop of tech companies that came of age when venture capital was plentiful. Like many others, related video too early to panic despite LYFT's drop, says early investor. Dropbox provides the closest analogy. It went public Snap provides an even more troubling comparison. The social media most. It's a story that will likely hear, as Uber, Pinterest, Slack and Airbnb all gear up to go public after already capturing very large valuations. The other overhang for the public markets is that only 11% of LYFT's outstanding shares are currently available for trading, with the rest mostly locked up for 6 months. When the lockup period, the risk for investors who hold the stock is that shares will flood the market and that not enough buyers will step up to meet that supply. LYFT can ease most of those concerns through execution. Back in 2012, then it took off. Investors who bought with LYFT, the story from here will be about its financial performance in the broad daylight of the public markets. Your
Raindrop, drop top, smoking, no cooking the hot pot. Fucking on your bitch, yeah, that. Looking up, open the park pot.